Joining me for the hour, Shannon Sakosha, Joe Terranova, Steve Weiss, Jim Lebenthal. We do check the markets, have extended those record highs, certainly for the S&P 500 and the NASDAQ 100 as well. So S&P and the NAS are still in the green, but you see the Dow down about 0.25%. Joe, interesting day thus far. Services sub 50. New orders were weaker. You know, yields have been creeping up of late. They are down. And then I guess no surprise in that little mix that tech is the thing that is leading yet again.
I keep emphasizing, to me, this is the story. This is the story going into the second half of the year. We think about the Mag 7 coming into 2024, and we had this moment where we said, no, it's either the Super 6 or it's the Fab 5. Well, guess what? Here we are back talking about the Mag 7 once again. You've had this remarkable technical breakout in Amazon, which is carrying forward. And now, how about Tesla? Tesla, since June 24th, it's up 32%.
It's up 6 days in a row. This would be 7. Today. It's up 30% back to June 25th, to your point.
Right. So you tell me, as you look forward into the second half of the year, I see a consumer that's weakening. Okay. I see the risk surrounding now we're beginning to price in the presidential election and the fact that that is impacting the long end of the curve in the Treasury market. I'm putting all that together and saying to myself, do I really want to move away from quality? Do I really want to move away from these Mag 7? I'm not so sure I have the evidence to suggest doing so again. And that's being said by someone who's equally weighted in their strategy.
Weiss, Apple, Microsoft, Amazon, all to Joe's point. New highs again today. You got some lofty targets still for the S&P for the remainder of this year. 6,000 is at the peak. And maybe it's tech that's going to get you there. If we can reach those heights, that it's going to be that trade that has worked and will continue to work. You got the highest target on the street, 6K by Evercore ISI.
Yeah, look, I mean, 10%, not even 10%, is sort of what you need to get to that 6,000 target. 10% in the back half of the year isn't unreasonable on the present fact pattern that we have. But there could be some complications. And one of those complications will be, as we saw immediately after the debate, that Trump's agenda, as he speaks about, forget about what he may or may not do, but as he speaks about it, is largely inflationary. So what you will have is you'll have a higher 10-year. That's going to reverse what we're seeing today, the weakness from the economy. And there's this push and pull. Is the data that's coming in going to drive the Fed, right, to lower points? And will they be able to sustain that? They're not going to base their monetary policy based upon who may get elected. They base it on what the data is at the time. But the bond market is telling you it will be inflationary. So the point of that is you sort of have to rethink what you've done to broaden out your portfolio and go back to Joe's point and stick to those companies that are least impacted by higher rates.
Now, maybe it's even trying to game out the prospect of, yes, what some would suggest is a more inflationary agenda. What also they would suggest in the same breath is a more growth stimulating agenda too. So if you're looking at the potential of a strong economy, you're going to get rates potentially moving up in tandem with the idea that it's inflationary too.
There will be stronger pockets. Look, every sector doesn't trade in one direction usually. Maybe on a day like today it does, but over any period of time it doesn't. So what will be impacted is that we're seeing interest rates, again to Joe's point, finally impact the consumer, finally impact auto sales, impacting home sales. So there's a large segment of the economy that higher rates is going to continue to hurt, not help.
Well, that's even the gentleman sitting to your left, Weiss, has expressed his concerns of late about the state of the economy currently. You get it backed up, his concerns backed up by the data. Services, as I said, sub 50, right? Service has been the strong point. It's been the manufacturing squirrely numbers we've been getting for the better part of a couple of years. New orders weaker, as I said.
Yeah.
I mean, look, I've been optimistic for quite some time. However, it is hard to maintain the optimism in light of the data that's coming in, like the ISM services. I mean, weekly jobless claims, yes, they've popped up. They're not at a critical level yet, but they certainly have moved higher. I want to be clear to everybody who's watching. I'm not selling stocks. I'm fully invested, and I am positioned for the broadening. But what I need to be clear about is that that thesis relies on rate cuts starting in September at 25 basis points and alternating 25 basis points thereafter. I know, excuse me, at every other meeting thereafter. I think the Fed, the danger here, and it is significant, is they think that since they've gotten away with this for so long, that the economy has grown, the labor market has maintained strength for so long with a very restrictive, I mean, the Fed funds rate, 5.5%, the PCE is 2.5%. That's 300 basis points. That's restrictive, okay?
Yeah.
They're not going to get away with it forever. And, you know, right now it looks like good odds, like September is going to be the first rate cut.
Yeah.
If that hangs in there, and if they do every other meeting from there, I think we can skate by. But I'm getting nervous,
Well,
man.
I mean,